Kia ora, ngā mihi nui ki e koutou, e na raurangatira mā, no mai haere mai whakatau mai ki tēnei hui mariko. Ko Barry Kotaho ko te kairahi o te putea whai whakaro. Te reira, tēnā koutou, tēnā tātou katoa. Tihei mori ora. So a very warm welcome to you all. I'm Barry Coates. I'm founder and CEO of the charity Mindful Money. We undertake these seminars in order to provide the finance sector, members of the public, regulators, media and others with information about ethical and impact investing. We've on our third series of seminars, and it's the 13th seminar in this current series. They're held on Wednesdays at 12:15, and videos and podcasts of previous seminars are available on Mindful Money's website, on YouTube, and other good websites. So today we're talking about the issue, what New Zealanders think about ethical investing. So the impetus of this seminar is a recent survey and report undertaken by the data research company called Donator, as managed by Mindful Money, and our partner on the surveys called RIA, Responsible Investment Association of Australasia. The report, based on the survey, was launched last week, but we wanted to use this seminar in order to do a deeper dive into some of the issues that haven't been fully discussed so far. I am very pleased to be joined by two panelists. The first of our panelists is Rebecca Stiles. So welcome, Rebecca. Rebecca is an investigative writer at Consumer New Zealand, where she writes on a variety of issues from insurance through to greenwashing. And I will invite you, Rebecca, to tell us a little bit more about your work in Consumer New Zealand. I'm sure most of the audience already knows about Consumer New Zealand's work. Some of them, sadly for them, may not be members and may not know about the full range of research information that you provide.
Kia ora everyone. Thanks for having me along to the seminar. So I'm an investigative writer at Consumer New Zealand, a non-profit who obviously deal with a lot of consumer issues, and there's plenty of those around at the moment. So we do, we have our test team that tests, vacuum cleaners and washing machines and things like that. And I'm in the investigations team, so we look at everything else essentially, insurance, supermarkets. There's a huge range of issues, and particularly they seem to all be coming to a head at the moment during the cost of living crisis.
Yeah, exactly. More power to you for the work that you're doing, and thanks for coming on to the seminar, because I think drawing that link between consumer products, other consumer preferences, and the issue of ethical investing is really helpful. So thanks for joining us. I'll introduce our second panelist, and this is Di Papadopoulos. Di is the Chief Customer Officer at Booster. And as many of you know, Booster is one of the leading investment providers in New Zealand, with KiwiSaver in particular, and also investment funds. And they have a long track record on socially responsible investment. In fact, I think Booster was probably the first of the main ethical investing providers in New Zealand. So welcome, Di, and please come and give us an outline of your work and what's happening at Booster.
Thanks, Barry. That was a great intro in terms of Booster's history. So we're a Kiwi investment provider based here in Wellington, with a real focus, as you've said, on responsible investing. So it's something that we've done, a long time before, you'd say it was cool, and something that we continue to have a really strong focus on. Really excited excited today to unpack a lot of, what you've seen in the survey, because it's, something that continues to grow.
Cool. Thank you, Di. So, without further ado, let's kick off the panel. I'm going to start off with the headline that we typically monitor to see what's happening, and it's the proportion of people amongst the general public, and this survey is a representative survey of 1,000 New Zealanders balanced by gender, ethnicity, the region where people live, and age group. So it's statistically significant, and we're kind of really pleased to have this data. And this is the 5th time we've done these surveys. So this year, what we've seen is in a way, a strong commitment still to ethical investing, despite the financial downturn. And there was a lot of concern that when financial markets go down, people might say, oh, well, I don't want to invest ethically anymore. I just want highest financial returns. What we've seen instead from this latest survey is that that's still around, so the data is slightly up at 74%, of 3/4 of people expect their investment provider, the KiwiSaver provider or their fund provider, to invest responsibly. And associated with that is a measure that says, talks about the number of people who will switch their fund if their provider doesn't behave ethically. And that number's gone up significantly to around 60%. And that's people who say they'll switch their fund if their provider has practices that aren't consistent with their values. So I wanted to kind of ask the question initially to Rebecca. These kind of are quite strong affirmations from consumers despite tough financial times. Are you seeing resilience from consumers still wanting to look for ethical consumer products or products? I saw you did a survey on willingness to look at climate-friendly products. Do you see this despite headwinds like concerns over the cost of living?
Yeah, our sentiment tracker did note that concerns about climate change and wanting to shop sustainably is one of the top concerns, and cost of living has come down, COVID has come down. So it is still front of mind for consumers, and I think recent weather events have just brought home the impacts of climate change on our daily lives. And also in our KiwiSaver satisfaction survey, 46% still want a good return along with ethical investing. And that's remained pretty solid throughout the years, whereas 34% are primarily focused on return. So I think, for most consumers, they want both. They want to make ethical decisions. They want to do the right thing.
Yeah, cool. And Di, it's obvious that the number of people who are switching funds because they're unhappy with the values of their provider is not perhaps as high as indicated by the survey. And one of the reasons may be that there's financial advice telling people not to switch their funds during a financial downturn, on the basis that it might lock in losses, for example. Are you seeing any evidence of that?
Yeah, well, I think one thing that we always look for is, what do people say their intentions are, and then what do they actually do? And I think that's something that we know, regardless of what's going on in the market, there'll always be some difference between those two things. I do think, though, in times when it's been tough and the markets have been volatile, people do question, what should I do? Is this the right time to be making a move? So there's definitely an element of that going on out there. However, I'd say what we have seen is that there's still, a really strong sentiment from people out there to keep investing in line with their values. So I don't think that fundamentally that has changed.
Yeah. That issue at the moment about when financial markets go down, the people shouldn't shift from, for example, growth funds to conservative funds because they might, as the saying goes, lock in their losses. Sometimes it forgets, it's not quite complete story, because if you shift, for example, to a more ethical provider within the same risk category, then actually you're not locking in your losses at all. And I think that's a nuance that sometimes doesn't make it through in financial advice columns and what people are reading about financial advice. If you switch from a non-ethical growth fund to an ethical growth fund, you're not locking in losses at all. It's a similar kind of risk profile. Do you think that may be a factor why this, because the data says there's been a bit of a downturn in the number of people switching their funds, even if they are quite interested to do so for ethical reasons?
Yeah, and I think that's an important distinction for people to understand, and because when markets first did start to take a dive, there was a lot of advice around that, and unfortunately, a lot of people didn't heed that, and so they did do exactly what you've just said, and they went from maybe a high growth fund to a conservative fund, and that's exactly what you've said, locking in your losses. That is very different scenario to moving from exactly what you've said, a growth fund to another growth fund across socially responsible or ethical lines. And so I think that that sometimes does get lost in the narrative out there, and just helping to give people a little bit of an assurance that those are two totally different things, I think, is really important, so that people do understand that those are very different scenarios.
Yes. Thanks for that. Let's move to how people choose a fund, and as you said, Rebecca, people do tend to, from Consumer New Zealand survey and also from this survey, people do tend to balance off looking for high financial returns, but also looking for sustainability or for aligned values in their funds. But one of the key things with KiwiSaver is because it's sold by banks, what the data shows from the survey is that about a third of people choose their fund because it's with their main bank. And this is slowly changing over time. It's down from 40% 5 years ago, but still having a third of people who just say, okay, I'm banking with X, I'm going to get their KiwiSaver so I can see it on a single statement, for example. Are you seeing in other areas that people are sort of perhaps changing their mind about that kind of loyalty and relationship?
We probably see results that echo what you have found. Most of our respondents, they do get their advice from their bank, and so they stay with their bank. And then the next thing would be to ask financial advisor, and then things like going to an independent source like yourselves, or sorted as it comes in at 15% of respondents go to that. So it's bank, financial advisor, and then perhaps doing your own research and seeing what you can find. So it's very much, and for those people that switch, they wanted to switch to their bank scheme for, I think, better visibility of their balance and things, just making it easier to go to one place. So banks are still very I think from our surveying, it looks like the first option that respondents go to.
Yeah. And it is interesting that people are now starting to ask more questions about their KiwiSaver and not just assuming that their bank's KiwiSaver is the right one for them. So I think that's where perhaps consumers are getting a little bit more discerning. From the survey, Di, 21% say they just go into a default fund because they haven't really made a choice. Um, you're doing a lot of work and talking to those people who come through default funds. What kind of things are they saying?
Yeah, so we make an effort to literally call every single one of the default members who come through to Booster. And it's really interesting because whilst, people might not have made a choice as to which provider they want to go to when they started a job, and you can understand why. Often, you've just started a new job and then you've been asked to then choose a KiwiSaver provider as well. It's a really busy time. That doesn't necessarily mean that you don't have a lot of questions and a lot of engagement in terms of wanting to get a good outcome. And so, interestingly enough, one of the most popular choices for us is ethical funds. And so what people really want to learn more about and understand more about is, what does ethical investing actually mean for Booster? If I come into an ethical fund, what does that mean? What will the exclusions be? But also, what will I be investing into? And so we spend a lot of time kind of unpacking that and helping people to understand what that looks like for them, and if it genuinely is in alignment to what they would want to do with their savings.
Cool. That's really helpful. So in all of this, there are in the survey some mention about the barriers to investing ethically, and those actually remain remarkably stable over the past 5 years. The top one is that there's not enough time to do research and compare options, and the second one is that there isn't enough objective information. And interestingly, the third one, which has grown over time, is people are concerned about greenwash. They don't believe the claims to be the funds are ethical. Do, do you how do those kind of factors relate to other consumer products, Rebecca? Are you kind of, is that typical for other consumer products? Obviously, here the low prices is not perhaps as big a factor as other consumer products.
Yeah, I mean, we find it's just that time and energy to compare products, and where do I go to compare products? And it's the same for insurance, and these are sort of stuff these are services that we provide on our website and stuff for members. With banks, it's just hard for people to to find the time to evaluate, and then what are they evaluating? I mean, more people in our surveys actually switch a high percentage actually switch their KiwiSaver provider. So it's at like 32% switched in the last year. We would go to car insurance and it's like 9%, or house insurance, it's like 10. So relatively speaking, people are a bit more proactive in switching KiwiSaver, whereas those other products like your energy, phone bills, whatever, people set and forget. But maybe with KiwiSaver, because you can see the balance, and if it's going up or down, perhaps that propels a few more people to make a change. But yeah, people very much set and forget. Life is busy, I guess, and it's hard to compare and to make the choice that's right for you.
Yeah. As you say, I mean, Consumer New Zealand does a great job with consumer products and providing the research and comparing options in ways that help individuals to do that. Mindful Money does that also kind of with ethical investing, and as we say, we do the research so people don't have to, but we're still a small charity, and a lot of people haven't found us yet to be able to tap into this research. One of the things that we found from the survey is that there are still some myths out there. And for example, one of the myths is a lack of good options to invest in. And I think that's may have been true a long time ago, but actually now there are quite a few options. There's been a real growth. in ethical investment availability across lots of different providers and different types of funds. People say sometimes it's hard to switch, but as you pointed out, Rebecca, it's really easy to switch KiwiSaver providers, and it doesn't cost you any money to do that. So that's another of the myths, and another myth maybe is that it will cost more in order to invest ethically, and as we'll see, that's a relatively small proportion of the public that think about that one. Di, what are you kind of hearing in terms of misconceptions or myths about ethical investing or boosters socially responsible investment products?
So I think one thing straight away to acknowledge is that there is an incredible amount of choice out there, and that can be overwhelming. But like we've touched on, it is super easy to switch, and so we do see that happening. One of the, I think, myths which has persisted for a long time was that the returns from SRI funds would be less than a standard fund. I think that myth has been well and truly busted over the years. So I think at Booster, what we have is a relatively unique perspective on this, because we run the two funds side by side. So we have standard funds and ethical funds. And so we've been able to track the performance of the two through market ups and downs. And so what we've learned through that process is that there is no disadvantage to one strategy over the other. And our customers have been really happy with their outcomes throughout, because they can see side by side that they haven't been at a disadvantage from investing in line with their values. There's been a really interesting stress test recently where markets have had a bit of a wobble, and there was a difference in performance for a while there, and then it corrected itself. And I think that's where people also realise that these are long-term investments, and markets will do what markets will do. But over the long term, ethical investments have shown that they're not creating kind of any disadvantage for people who choose them.
Yeah, I think having read a lot of the comparative literature, of big studies over the past decade, I think generally the formulation is that ethical investing has returns that are at least as high, if not higher, than traditional investing, and you certainly see that in terms of some issues like the returns to fossil fuels, which are excluded by many ethical providers. And the returns to fossil fuels may have had a little kick up over the last couple of years, but over a 10-year period, they have on average been 15% lower per year than the general market. So it's a huge difference there that's driving some of that change. I observed from the survey, we asked the question: do you think that returns from ethical investment are higher over the long term? And we've seen this number change quite dramatically over the years we've been doing the survey. And now 45% of people say, yes, they see it as being higher long-term returns from ethical investing. There's another 45% say, well, we're not quite sure, probably about the same. And then only 10% disagree. So I guess that's kind of consistent with your findings from Booster, Di. But maybe, Rebecca, this is kind of unusual for consumer products, right? Because you generally pay more for the ethical products than you do for those that aren't ethical.
Yeah, very much so. Yeah, if you're walking down the supermarket aisles, you'd expect to pay more for the the ethical product, and then hopefully it is ethical and it's not just being greenwashed, so you're paying for nothing. Our own surveys sort of don't drill down into that level in terms of I guess whether they're prepared to pay more for an ethical investment, but just more people would like, the returns and the ethical. We did ask for the first time whether respondents thought the providers were making genuine efforts to invest ethically and sustainably, and while 39% agreed that they were, there was an equal proportion that said, well, they weren't really sure, they neither agreed or disagreed. So I guess it's that communicating what the providers are actually doing clearly, and what they are and aren't investing in. Because we also ask, about the sin stocks, the sort of bog standard, what you probably shouldn't include in the sustainable fund, and people weren't sure. They sort of hoped that they weren't investing in those things, but they weren't sure at all. So that's quite telling in terms of providers needing to give that information more clearly to their customers.
Yeah. Yeah, we ought to send them over to Mindful Money to have a look.
Yeah, exactly.
The issue of greenwashing, people being unclear about the claims that are made to their products is a big one for these surveys. So about half of all people are concerned about greenwash claims, and that's kind of being reflected internationally in regulators of financial markets starting to take action on greenwashing. And in New Zealand, the Financial Markets Authority has issued guidance, has expressed concern about this. Di, kind of, it's difficult to ask you as a provider who's got SRI products, but do you think the others have got some claims that perhaps need to be better substantiated or with better evidence provided?
Yeah, well, I mean, I can only really speak for ourselves and in terms of the standards we hold ourselves to. But I think, what we always want to make sure is that, people know what they're getting in the box. And honestly, it's not that hard to do. So if you come to our website, very clearly, you'll be able to see exactly what our exclusions are, so what we don't include in our funds. You'll be able to see our policy, which goes into exactly what that means. So when we say we don't exclude this, we then break down exactly how we go about doing that, what our thresholds are, and how we implement those decisions. And then you will be able to download a list of exactly what we hold in our funds. It's a pretty simple formula for us in terms of giving pretty clear transparency around what that is. And I think the other thing is, where this can be a little bit difficult is that we don't claim when we go out and say that we've got, an ethical fund, that we have, any kind of moral stance on saying this is what good values are and this is what bad values are. We're just saying this, we've constructed a fund, and based on the feedback we've had from our customers, these are what we believe to be the most important issues. And so we're going to make it really clear to you what we have and haven't included. And so I think, if everyone's on the same page, then people can make a choice. And at the moment, they're voting with their feet and they keep piling on in. So we're really pleased with that.
That's really interesting. When we started Mindful Money, we were aware that individuals have different ethics, and we thought that when we went out to survey what people want to avoid, we'd get very disparate answers. That hasn't been the case at all. That there's a huge amount of commonality amongst the New Zealand public about the kind of things that they want to avoid in their investments, and even to the stage that we ask kind of people which categories of things they want to avoid. The top 5 categories is unchanged from last year, and even the percentages are unchanged from last year. So, for example, 90% of people want to avoid companies that have a record of violating human rights, and that has been the top issue for essentially for the last 5 years. So it's absolutely kind of solid over a period of time, and and quite broadly held values. And it's kind of interesting because, we often get people saying, oh, yeah, ethical investment, we've all got our own ethics. But actually, there is a lot of commonality in people saying, I don't want, human rights violations. I don't want cruelty to animals. I don't want to invest in weapons and fossil fuels and these kind of things.
Indeed,
Is
and
that your experience, Di?
yeah, we regularly review exactly what is in and what is out of the funds, and talk to people about, does this match your expectations? I think our view is probably that we would need to make more changes than we do. So over time, we have excluded more and more from the funds. But like you say, it has been a relatively stable view of the world that people have held.
Mm. And Rebecca, your own surveys have I think we've seen similar kind of categories, similar kind of results over time.
Yeah, I mean, we, us tobacco, fast food, those sort of the general sin stock stuff, we don't, I guess, go further down to that. But yeah, animals, human rights violations, and nobody wants to be investing in any of that kind of stuff.
Yeah. The surprise is that there's quite as much investment as there is in some of these things. We prepare a kind of a pie chart of all of the KiwiSaver money, for example, that goes into some of these categories, and there are very large numbers, around $7 billion of KiwiSaver funds. And in fact, when we did our first surveys, we found $130 million going into companies that made nuclear weapons, which for a country like New Zealand is pretty remarkable. Over time, we've been able to work with providers, and that's now less than 10 million. But still, it is surprising. Yeah. So, what other issues struck you from both from reading the survey? Is there anything we haven't talked about that you found particularly interesting or surprising about the survey?
I think there's probably one other area for us that has been a quiet but growing trend, which the survey picked up on, and that is around impact investing. And clearly there is a growth in interest in that area. And I think it's one that the market as a whole hasn't necessarily come up with a whole lot of solutions. And I think there's probably different reasons for that. Often, impact funds can be maybe focused on one issue, and particularly for a KiwiSaver fund where you're trying to provide a lot of diversification, that can be a little bit tricky. Within our funds, how we have tended to address that is off the feedback we've had from our members. We have a innovation fund that targets particular technologies that are very beneficial in terms of sustainable new fuels, or taking terrible kind of petrol engines out of waterways. And so we've addressed that by creating these kind of opportunities into the funds, and that's where our investors have kind of said, well, we see that as our way of creating impact. And so I think for us, there's different ways to achieve impact, and I think that's probably a bit of a journey that the whole space is still to go on, and there's probably just a few different ways in which we can kind of cut that one up.
Yeah, it's interesting. So as you know, Di, we're working with Booster and other providers to see where the barriers are to acceleration of investing in what's often called impact investing, or investing for positive benefits. And there are some great examples out there, like the Innovation Fund, like investment in social housing, investment in renewable energy, etc. but it's still a really small part of the mainstream funds. And we're keen to kind of see where those barriers are, see where the opportunities are, and see if we can over time get a far larger allocation of funding for positive impact. I think that really has the potential to leverage in some funding to meet the challenge that we have ahead around infrastructure and climate change and poverty and a lot of other issues. Rebecca, what struck you about the survey? Anything?
I guess as I've recently written an article that's in the Next magazine about ethical investing, and one of the things that cropped up was just the language of investing and KiwiSaver, and it's a real. If people are just relying on the marketing or what's on the website page for a bank or whoever, it's really difficult to penetrate the more technical information to get what you want out of it. So I'm very keen for like plain English, or just to make it easier for people to interact with the language of investing more generally and perhaps finance more generally. But in particular for KiwiSaver, given most of us have a KiwiSaver account, just to make it, it should be quite easy information to understand because it's so important for your future.
Yeah, and that was one of the questions that we asked in the survey around, are you receiving information from providers, and are you happy with that information from your KiwiSaver provider or your investment provider? And actually, relatively few people were really happy with it. And I know you do consumer satisfaction surveys, Rebecca, around around some of these issues.
And I think most people were. Sorry, I'm looking at my list of numbers here. Most people were happy with the information they're getting, but I guess it's you don't know what you don't know. If you're given, oh, here's my return, but actually you wanted to know something else. I think maybe we could drill down into those questions and, what information are you getting? Are you getting, is it returns, or is it clear information about what you're investing in and whether those investments have changed? Perhaps it's something we need to drill down into for future surveys.
Yeah. So the data from this survey said the quite low number of respondents who were really happy with the information that they get, and I guess it's partly because of that issue about it being difficult for them to understand, or not the kind of information that you require. Di, is there a need for better regulation to provide comparable information on ethical investing? I know we're getting better information on climate change coming, so we're going to hear about climate emissions due to government legislation. But do we need also regulation about environmental impacts or social impacts of investment?
Yeah, so I think, to be honest, there's regulation and guidance in place right now, which should prompt us to, in terms of when we're promoting our products, give a really good level of information. The fact that it is difficult to compare, I think there's always a challenge in terms of regulating at that level. I think what you're talking to probably, though, around the level of communication that we provide to our customers in an ongoing way, is where it's really important that, and I think it shows the ongoing kind of commitment to customers once they come through the door, is where providers can really show their mettle. Because we recently, and there's like many different ways in which you can communicate, but one of our initiatives is we do something called Member Days, and we're somewhat uniquely placed in that some of the investments which are held within our funds are Kiwi companies, so they're sitting here in New Zealand, having an impact right here. So investors can actually come along and talk face to face with those companies themselves and understand from the CEOs and founders exactly what they're doing. And so I think it's really more probably about how, asking that question of your provider about how are you really creating those connections for me, so I truly, genuinely understand what is going on with my investments. Because if you've signed up and you've heard nothing more, then that's probably a problem. But if you are understanding who these companies are, what they're doing, and you can make sense of that yourself, then I think you'd probably be sitting there resting a whole lot easier.
That's interesting. So that approach would be a little less government regulation and reports that people never read, and a bit more about making that engagement and connection with consumers on things that they can understand.
Yeah, that's right. And I think to me, that's where regulation absolutely has its place, and there's a certain level of transparency we absolutely have to have. But what I do know is that often consumers tend not to engage in some of those things. So where we will ultimately be judged is, where are we providing that value, and where are we making sure that they do understand what is within their portfolio. And so that's where I think we also have a responsibility on the other side, which might not necessarily be regulated, but where the consumer really understands and knows what's going on.
Yeah. Hey, I thought we've got just a couple of minutes to go. I just thought, last question. There's some interesting data in the report about those who haven't yet invested in ethical investing, but plan to do so. So 27% say they'll consider it in the next year, and another 23% say they'll consider it in the 2 to 5 year period. Di, is that kind of give you nice feelings about the potential market for ethical investing going forward? Is that consistent with the sort of a growing demand that you see?
Yeah, absolutely, and that tracks the trajectory we've seen in recent years. Ethical funds are the fastest growing area, I think we would see across the market, and is also why we need to get this right. And it's really important that people do understand, what it is we mean when we say an ethical fund, because they come in all different flavors. So people should understand what it is that they're getting into.
Yeah. And Rebecca, how does this look with the rise of consumer preferences around ethical and climate friendly issues in consumer products?
Yeah, I mean, nearly half, do want an ethical fund and the return. So I would expect that to go up as things like climate change just creep up on us more and more. And hopefully with those numbers, maybe with those numbers that are switching, that the ethical will be more front of mind than perhaps it was, say, even 2 or even 5 years ago.
Yeah. So thank you both very much. That was great, and really enjoyed the perspectives you were able to bring to it. So thank you so much for participating.
My pleasure.
Thank you.
Just to finish off, as I said, these surveys, ones we've done for 5 years, please go to Mindful Money's website, and you can see the results of the survey. It's all there, the report, press release, the launch seminar, and we'll put the seminar link up there as well. What's really interesting to me is, as the final comments from Di and Rebecca said, this is an area where there is considerable growth. There's concerns about greenwashing. There's concerns about whether or not this really delivers But actually, overall, I think we've seen a huge change over the last few years in the availability of good, credible, ethical and impact investing products. We're now seeing the positive impact opportunities start to come through, and I think this is an exciting time ahead. So thanks again to Di and Rebecca for that discussion. Thanks also to our generous sponsors of this series. The main sponsors of the series are Alphinity, Medical Assurance Society, MAS, Mercer, and Green Investment Finance. We also acknowledge the support of Chapman Tripp, Booster, thank you very much, Di, Harbour Asset Management and Trustees Executives. We've also had contributions from Pathfinder and PyFunds. So thanks again for joining us on this seminar. Please stay active, invest mindfully. Mā te wā.